Good morning, everybody. This is Gaus again here in Chicago with EFG and IFG, and it's Thursday, which means it's Numberology Day with a special treat. Today, when we take a look at commodities that are giving us an indication that they may be ready for a trend change according to the LAWG 647 model, there's only one, and that is the September cocoa. September cocoa will turn bearish tomorrow on a close at or below 30.78. And as coming in here for taping, it was only trading at 30.63. So as you can see, we're already below that number, but not terribly below the 30.78 number, which could become a battleground price and give us some pretty good activity over the next trading session and a half. Having said that, let's take a closer look at the October crude oil chart. It is my chart. It's a handmade chart. I keep all my charts by hand, so it isn't real pretty. But you'll notice on the chart there's a heavy black line that I drew in there just for you folks, and that's the 50% line, or the line that I call price equilibrium. There's also a green line that is on top, and that is the positive indicator line. And there's a purple line on the bottom that is significantly right at the bottom of the sheet. You'll notice that is the negative indicator line. And it is my opinion that both those lines will over time come back and meet or come close to meeting at the 50% line, which is an indicator that there could be a dynamic trend change taking place. But while we're in a dynamic trend like we are in the crude oil, you will notice that the difference between the purple line and the green line is pretty wide. And that tells us that things are getting overstretched. And in fact, if we take a look at today's values and overlay it on that chart, it is even more overstretched today than it was last Friday. In fact, it is overstretched to the point that the negative indicator is at a negative 15%. Now, what does that mean? What does that tell us? Well, what that tells me isn't that the market is necessarily going to change its trend. It does tell me that the market is getting overstretched. And for no real good fundamental reason, we could see the market snap back on a rally and create some short-term profit-taking buying from the present levels or levels in the near future. So I'm not telling you to buy crude oil. This is not telling you to buy crude oil. It is telling you to be very careful. Be careful about selling crude oil in the hole or significantly lower on any day. If you want to be short crude oil, show some patience. Look for rallies. The market will give you some rallies, in my opinion, that you can sell. So that is one of the indicators that we use. When we see the two positive and negative indicators either becoming very, very close together, we are going to be mindful of a very possible dynamic trend change, or as they get further and further and further apart, especially in negative territory, or even as it approaches zero, we're going to be very mindful of a possible correction in the price going in the opposite direction. On bullish markets, we will see it in the 90, 100, over 100 percentile level. And as you can see in the crude oil, we can see it in the negative category. One thing to keep in mind, all commodities have different parameters. Some are more volatile than others. Some get into the negative category more than others. So every commodity has their own parameters. Now, having said that, I want to thank you for enduring this. I want to thank you for watching it. I want to emphasize that trading commodities and commodity futures is risky. You need to be aware of the risk you're assuming when you trade commodities. For more information, you can go to www.ifgfutures.com. You can email me at lee@efggrp.com, or you can call me at 312-384-1184. Again, that's 312-384-1184. Be more than happy to chat with you. Hey, have a great trading Thursday, have a great trading Friday, and even more important, have a great weekend. This has been Gaus at the offices of EFG IFG here in Chicago.